Everyone thought the AI boom was supposed to make technology stocks richer, stronger, and almost unstoppable. But over the last few hours, the market started sending a very different message. AI is still growing, but the cost of that growth is now becoming impossible to ignore. And that is why today's story is not just about chips, Apple, Microsoft, or Bitcoin. It is about who is actually paying the bill. The clearest signal came from the memory chip market. Micron became one of the biggest winners because artificial intelligence needs enormous amounts of memory, storage, and data center capacity. When demand for AI infrastructure explodes, companies that sell the essential components can suddenly gain pricing power. In simple words, the AI boom is still alive, but the money is moving toward the suppliers who control the bottlenecks. That is where the story becomes more uncomfortable for the rest of big tech. Apple is not a pure AI infrastructure winner in this moment. Apple is a company that has to buy expensive chips, storage, and components before it can sell finished products to consumers. If input costs rise too fast, the company has only two choices: protect margins or absorb the pain. Today, the market is reacting to the idea that AI costs may be moving from data centers into the price of real consumer devices. Microsoft shows the other side of the same problem. The company is one of the most important AI leaders in the world, but leadership is not free. Investors are starting to ask how much money needs to be spent on servers, chips, cloud capacity, and infrastructure before the return becomes clear. This is the moment when Wall Street stops clapping for the AI dream and starts asking for the invoice. That is the tension the calm metrics wants to focus on. The headline is not "AI is dead," because that would be too simple and probably wrong. The better headline is that AI winners are narrowing, and the market is separating companies that sell the picks and shovels from companies that have to keep buying them. Micron can rise because it sits near the supply bottleneck, while Apple and Microsoft can fall because the market is questioning cost, margin, and timing. This also explains why the broader market feels fragile even when one part of the AI trade is still hot. A stock market can have strong chip demand and weak mega-cap sentiment at the same time. That is exactly what makes this story important for investors. The market is no longer treating AI as one clean trade where everything goes up together. It is now choosing winners and losers inside the same theme. Bitcoin is connected to this because Bitcoin is still behaving like a risk asset in this environment. When investors become more cautious on big tech, liquidity does not automatically rotate into Bitcoin. If ETF flows are weak and the dollar or yields stay firm, Bitcoin can struggle even if the long-term crypto thesis has not changed. For now, Bitcoin is not leading the market. It is reacting to the same risk-off pressure that is hitting speculative assets. So the real lesson today is not that the AI boom is ending. The real lesson is that the AI boom is becoming more expensive, more selective, and more dangerous for companies that cannot prove the payoff fast enough. Wall Street still believes in artificial intelligence, but it is becoming less patient with companies that need to spend billions before the profit shows up. And when the bill gets bigger, the market always starts asking the same question: who pays, who wins, and who gets left holding the risk?